Miss one detail in a 1031 exchange, and the IRS treats it like it never happened. A real estate investor in Colorado sold a $600,000 rental property, intending to do a 1031 exchange. She'd been planning it for months, had already found a replacement property she wanted to buy, and felt confident the whole thing was under control. 3 weeks before closing, she mentioned the exchange to her CPA, almost in passing, just confirming she had already handled everything. Her CPA asked one question: had she engaged a qualified intermediary yet? She hadn't. She assumed she could set that up after closing once the proceeds were in hand. Her CPA stopped her mid-sentence. In a 1031 exchange, the qualified intermediary must be engaged and the exchange agreement must be signed before the deed transfers and the proceeds even change hands. Not the day after, not that weekend, before. If the closing happens first, even by a single day, there is no exchange. The IRS gives no grace period and no do-overs. Hi, I'm Sherry Ayland, CPA and tax advisor, and I help real estate investors pay little to no taxes using my zero tax blueprint. In this video, I'm going to walk you through the most costly 1031 mistakes investors make and the specific things that you need to do to make sure that none of those happen to you. Mistake number 1, not hiring the qualified intermediary before closing. This is the most common deal killer. Many investors assume they can set up the exchange after the sale closes. They cannot. The qualified intermediary must be designated and the exchange agreement must be in place before the deed transfers. If sales proceeds go to you or your attorney's escrow account, even briefly, constructive receipt has occurred and the exchange is disqualified. Period. No cure. A practical rule is to engage your qualified intermediary at least 2 weeks before your scheduled closing, as soon as you have a signed purchase agreement on the relinquished property. Just briefly mention here again that your attorney or CPA is disqualified. Your own advisors cannot serve as qualified intermediary. Mistake number 2, missing or misunderstanding the 45-day rule. Many investors treat the 45-day window as casual. They'll know it when they see it. The identification must be in writing and delivered to the qualified intermediary. It must be specific enough to identify the property unambiguously. A county name or neighborhood is not sufficient. People also miscount. Day 1 is the day after closing. Weekends and holidays count. 45th day is the 45th day. Also, investors who identify just one property and have it fall through after day 45 have no recourse. Mistake number 3, this one surprises even experienced investors. The exchange period is the earlier of 180 days or the due date of your tax return, including extensions. If you sell a property in November or December and don't file a tax extension, your 1031 window could close on April 15th, well before 180 days. For example, you sell on November 15th, 180 days is May 14th, but the tax return is due April 15th without an extension. The exchange period ends April 15th. Always file a tax extension if you initiate a 1031 exchange in the fourth quarter of any year. This costs nothing and protects the full 180 days. Mistake number 4, taking boot unintentionally. Many investors don't realize that certain deal structures trigger partial taxable boot. Receiving a security deposit from the buyer that isn't properly handled through a qualified intermediary can be boot. Getting reimbursed for prepaid property expenses, insurance, and property tax at closing without routing it through a qualified intermediary. Paying off a line of credit secured by the property at closing. If the debt on the replacement property is lower and no extra cash is brought in, that's mortgage boot. Personal property included in the sale, like appliances and furniture. Since personal property does not qualify for a 1031, any allocated value to personal property is taxable. The fix for that: work with your qualified intermediary and closing agent to make sure every dollar flows correctly. Mistake number 5, using a disqualified or unvetted qualified intermediary. This is an underreported risk. Qualified intermediaries are largely unregulated. Anyone can call themselves a qualified intermediary. There have been documented cases of qualified intermediary firms going bankrupt or committing fraud with exchange funds, leaving investors with massive unexpected tax bills and no recourse. Here are some red flags. Qualified intermediaries that commingle exchange funds with operating accounts, no fidelity bond or E&O insurance, no physical office, and newly formed entities. As a best practice, use established national qualified intermediary firms. Verify they hold exchange funds in separate, segregated accounts and confirm they carry fidelity bonding. Mistake number 6, exchanging dealer property. If you buy property with the intent to sell it, a fix and flip, the IRS may classify you as a dealer with respect to that property, and dealer property does not qualify for 1031 exchange treatment. The issue is intent at the time of acquisition. You bought it to fix and flip and then changed your mind and tried to exchange it, the IRS can challenge that exchange. The classic danger zone, a developer who holds some properties for investment. The IRS may argue all properties are dealer property. Safe harbor practice, hold your property for at least 12 to 24 months and document the rental income or investment intent from day one. Mistake number 7, forgetting that the basis carries over. This is not a disqualifying mistake, but it is a costly planning error. Most investors exchange into a larger property and think their depreciation resets to the new purchase price. It doesn't. Your carryover basis from the old property determines your starting depreciation on the new one. For example, if you sold a $350,000 property with $150,000 in remaining basis and exchanged into a $600,000 property, your depreciable basis starts at $400,000. It's the $150,000 carryover plus the additional $250,000 investment, not $600,000. This affects cash flow projections and future depreciation planning. A cost segregation study on the new property can help maximize the depreciation you're entitled to take on the new value added. So, to summarize, the common mistakes: not hiring a qualified intermediary before closing, missing or misunderstanding the 45-day rule, the year-end tax filing trap, taking boot unintentionally, using a disqualified or unvetted qualified intermediary, exchanging dealer property, and forgetting about the basis carryover. Most of these mistakes are entirely preventable with one simple habit: engaging your qualified intermediary and your tax advisor before you sign anything, not after. The investors who get burned almost always try to figure it out mid-transaction. To see if you are a good candidate for my zero tax blueprint, check out the link below and complete a short survey to get your zero tax readiness profile.